If you have any questions along the way, you can type those in, or I'll try to open it up for Q&A here in just a bit. So let's get right into it. And feel free to send me a message, chat it if you'd like. Reagan will also, I think, be listening in. Reagan, can you put a chat in here to make sure you can hear? Put a chat message in if you can hear me. Okay. Very good. Well, we're going to get rolling and get started here. Okay. So we're going to talk today about the market update, what's going on. A lot of concern. I mean, the markets today are reversing all their gains that they had yesterday. Thank you, Keith. Glad you can hear me. And so basically, we're going to go through and talk about where the markets have been, where they're at year to date, and then also discuss what could take place. And if we look at just FYI, here's information on our firm. Most of you guys are attending our clients, but I think there are a few people that aren't. So we wanted to make sure that you knew who we were. And basically, we help clients in growing and protecting their wealth. Okay, market updates. You can see here for April, the 22nd, April 2022, S&P was down 8.6, NASDAQ 12.1, S&P small caps down 8.1. Commodities were up 6.6 for the month of April. Now you look at the year to date, down 12.4 on the S&P, 19, almost 20% on the NASDAQ. S&P small caps down 11.9 and commodities up. Now this commodity basket is a basket of, we've got basically agriculture stock, commodities such as wheat, sugar, soy, corn, and then it includes also some livestock as well, hogs, pigs, and so on. And so that's the core, but it is up 32+% year to date. That can tell you where food inflation has been. Well, let's talk more about commodities and material stocks. Oil was up roughly 5.7% for the month of April, and year to date around 41%. Energy stocks, these are like energy companies, basket of stocks. We're down roughly 1% for April, but still up 41% for the year. Material stocks such as your mining sectors and your Cats and John Deere's and those kind of companies were down 4.8% for April, which was the biggest month down this year for them, down 5.4%. And then gold was down about 3%. It was stronger through to the end of the last 2 weeks of April, then has kind of given away a little bit, down about 3% for April, but still up for date for the year, 1.8%. So you can see commodities has still been a very big factor in the markets today, with inflation and oil prices going higher. Now let's talk about the fear sentiment, the fear versus greed. So as you can see from this chart, we're in what we call just the regular fear. Last time it was neutral. And this is based upon, I believe, May 3rd, just a couple of days ago. So really, to get into the market where it really starts to put in a bottom at some point, we need really more extreme fear. And so we're probably going into that stage of the market right now. The market's pulled back, as you can see, but we're going to have to get probably an extreme fear at some point before we get finally a bottom being put in. And so I think we're still probably, who knows, it could be 5%, 10%, 20% from these ranges we're in today, but we'll see. And we're definitely seeing some buying as of yesterday with the Fed's interest rate increase and their language about not increasing it probably more than 50 basis points. So the market liked that, it rallied, but today it's giving it all back. So we're going to be probably in some rockier times, at least in the near term. Meanwhile, bonds are in negative territory. So historically, bonds have been, a way to diversify a portfolio and provide income, and it does provide income. But because interest rates are going higher, bond prices are going lower, existing bond prices. So year to date, the treasuries are off 20%, corporate bonds around 14, 15%, and high yield corporate bonds around 10%. So even bonds are in, not a safe haven necessarily at this time, because interest rates are going up. It causes bond prices to go down. And I'll talk more about that here in just a minute. But when you look at stock price strength, new 52-week highs and lows. So the trend, there's more stocks making 52-week lows than there are highs, extreme. And so this indicates, people are concerned and prices are going down. Then you get into the volatility index. Now, this index basically measures the put call premium ratio, those who are bearish versus bullish in the market. And the VIX has been moving higher recently, as through April up into recently. And so volatility is caked back in. Now, it hasn't gotten high enough yet to say that we're going to be, that we won't have more volatility. Naturally, when the markets tank or go down, you're going to see more volatility in place. But when you look at the VIX, and let me throw a chart in here real quick. When you look at the VIX at this point here, what you're looking at is, okay, so oops, let me get rid of that. I messed that up. Hold on just a second. There we go. So this is a longer term picture of the volatility index. So as you can see here, recently in the last, year or so, volatility has come way down, but it's put at a bottom here back around the March level. Now volatility is starting to go back higher. I think if we get a volatility breakout of this range right in here, so somewhere here when this VIX fund index gets around $30 range, which is at 25.93 now, that means the trend is definitely toward the up. As you can see, the moving averages here are moving. The 50-day moving, this green line you see here is moving up through now the 200-day moving average, which is here. And so that's an indicator of a bottom being put in place, meaning possibly more volatility ahead. Okay, then we'll talk about how we're going to deal with that volatility going here in just a bit. A lot of it's due to inflation. Huge, and then that's why the Feds are trying to raise rates. The real inflation rate is probably in that 16% range, right in through here. This is the way they figure it now, which is in that 8% range, they say. But the shadowstats.com, this is an alternate method of the way they used to figure the CPI. And this is the blue. And he's got this pegged at probably over 16% inflation versus what they're telling us and showing us here at about 8%. Inflation is a big concern for the markets and, of course, for consumers spending. And of course, a lot of it is due to the shutdowns that we've seen. I want to say engineered shutdowns. This is a picture of one of the ports. I believe it's maybe Shanghai or could be Beijing. Massive shutdowns with COVID restrictions and lockdowns there. So we had these shutdowns, especially in the ports in LA and other ports, for a number of years now, a couple of years really. It worsened last year, and I think we're going to see more inflation due to this right here. Shanghai is one of the larger ports in the world, along with Beijing, and those ships are just sitting out there, hundreds of ships. So look for price increases, look for prices not only increasing, but also supplies decreasing within your convenience stores, department stores, grocery stores, et cetera. Because we probably won't feel the effects of this Shanghai and Chinese issue until probably June or July, somewhere later this summer. So what you can do to help prepare is just, the things that you're going to use and need, say, in the next 6 months. Don't be hoarding perhaps, but go in and buy some extra things that you think you might need. So you make sure you can have those at this time. But that's, unfortunately, this is going to continue. It's been kind of an engineered thing as you look back over the actions that have been taken the last year or so. It's not very friendly to consumers and our dollar and our currency. Now, let me ask you this. Are you currently bullish or bearish? Let me see if I can release the first poll. Oh, no. Megan is out of the office. She normally does these polls for me. So let me see here. I think we're not going to be able to do that today. But historically, the last month, most of you determined you were more bearish in the last month or so. I would assume to say most of us are still bearish. But if you want to send me a chat, whether you're bearish or bullish, that would be helpful to kind of see what you guys think. Well, here are some things that could continue to cause more fallout in stocks. The Fed raising rates, which they are, and aggressively, it's the highest they've done in many decades, at least 2 to 3 decades of raising rates. And so they're looking at 50 basis points over the next couple of sessions that they meet. Continued higher inflation. I don't think the interest rates raising is going to cause, because this, in other words, cause inflation to go down, because this is not really an interest rate problem. The problem is we have all these shutdowns and ports and restrictions for the flow of products. So it creates a limited supply. And with all the Fed induced and the government induced spending and getting checks to everybody and businesses, it's created huge demand chasing fewer goods. And so that's our problem. We need to release those supply chains and get that figured out in order to really overcome inflation. So raising 50 basis points here 50 is not going to necessarily, it might slow down some demand, but what it's going to do is slow down the economy. And many fear that it could put us into recession. So continued higher inflation is a really big concern right now. Of course, rising rates can hurt stocks, but also can hurting bonds. And then, of course, there's the political and geopolitical fallout. This, by the way, is the same thing that I had last time. Nothing's really changed since last month. You got Ukraine and Russia situation, possibly China, Taiwan. There's all kinds of fallout that can happen. And of course, the black swan event is where you're blindsided. There, nobody expects something happens, and that could cause turmoil in the markets as well. So let's talk about rates. When rates go higher, bond prices go down. So interest rates are going up and bond prices are going down. And most of you may know this, and you may have heard me explain this. If I were to give someone a piece of paper that said, hey, I'm going to give you 2% on a 10-year note, and you hold that note for 10 years, you're going to get 2% a year paid semi-annually. And so you'll get 2%. But if rates, let's say in the years 2 that you have that note, rates go up, new rates go up to 4% for a 10-year. Well, you're sitting at 2 and you want your money to get more. You'd have to sell that bond at a discount. It's priced lower than par in order for someone to say, hey, this is attractive for me to buy it cheaper and get the 2% and plus the gain when it matures versus buying a 4% note today. So the bond prices have to go down when rates go up. And when rates go down, like they have the last 20 plus years, then bond prices go up. And that's what we've been seeing until just recently. So the concern is as rates, short-term rates go higher and longer-term rates aren't moving as much, you get an inverted yield curve where, say, the 10-year is paying the same or just as much as the 30-year. Well, normally when you go out further, you want 30 years, you're going to take on more risk, more time risk, right? 30 years. So inflation risk and so on. So usually the 30-year is much higher than the 10-year note or the 5-year note because you're taking on more risk. And so you get rewarded more and get a higher interest rate. So when yield curves invert and they're both paying about the same, then typically what happens, short-term rates are going higher, long-term rates lower, and they invert, then you typically have a stock market decline like we've seen here in previous years in the late 90s, right here, where the interest rates went down, stock prices go up, and eventually interest rates go higher and stock prices go lower. And so this is kind of a trend that we see. So right now, you know, with interest rates have been fairly low, but now they're starting to curve up. So there's a good chance we could see stocks continue to go down for a little bit, and like they have here in the last, few months, especially year to date. Let's look at the big picture. This is 122 years of a secular bull and bear markets. And we're going to start talking about where we're at today on this chart. So historically, you have red areas where the markets are bearish, where they either go flat or trend downward. Stock price valuations go lower. So the stocks become cheaper. And at some point, they become cheap enough where a new bull market then can ensue and continue. That's what you have during these periods, bull markets. Okay, but typically stocks have to get down in the price level of 10 or below. Well, we're currently at about a 36. Okay, and it's come down recently, the last month or so, a little bit from 39. This was back in the tech bubble. So when you're investing and during periods where stock prices have been elevated and are high, at some point we need a bear market to bring the prices lower and make them more affordable. So many of you have seen this chart before, but basically this says if you start your price to earnings in this range here, that means at some point stocks are going to have to come down in the near future. And so that says here, historically, if you start any 10-year period with PE ratios at this level, then your next 10-year average rate of return is probably going to be 0 or flat to down some. If you're investing in where PE ratios are more affordable in that 5 to 10 range, for example, then you have the next 10-year, you have potentially to make 10% per year on average. So what this tells us is that it's not where you shouldn't invest. It just means if you're a buy hold investor and you're investing in passive like index funds, then be prepared for in the next 10 years, prices are going to have to come down substantially in order for there to be another bull market. So what we want to do is be picky. We want to be selective. We want to be defensive during these times. And what we're seeing now, what we call is fact-based investing, where it's basically looking at supply and demand. We don't try to make market predictions. We don't require that markets or investors be rational or efficient, and we don't remain fully invested regardless of the circumstances. So when we implement that, we look at what the market is telling us, what is versus what might be or what ought to be or could be. So you're going to get tons of opinions. What cracks me up is on CNBC, I have it on while I'm working, but yesterday was all euphoria, right? Okay, position yourself to get back in, and here's the bottom, and then today we've got the market giving back everything it made yesterday, and now they're saying, okay, how do you protect yourself in this market? So it's kind of funny. You're going to hear all kinds of opinions, all kinds of what should be, what might be based on history and all that, and really nobody has a clue. And so what we do is stick to the facts. Let's look at what the markets are telling us, and that's the best gauge. And you'll get about 200 different opinions on CNBC or other types of money shows of people giving their opinions on what could happen. And you hear many different avenues and venues and voices giving their direction. And like I said, really nobody knows what's happening. So what we do is we look to the facts, and this is our bull bear indicator. And as you can see here, March the 4th, went into a bear market. Let me back that up here. There we go. Went into a bear market. Now, what's that mean is this line is kind of like the EKG of the market. It looks at supply and demand and many other factors of the market and kind of puts them in a single line, kind of like an EKG looks at your body, right? And gives you a positive or a negative reading. This turned negative back in March 4th. And at that time, we just raised a pretty good chunk of cash within the accounts and in our models. And so basically, the market has pulled back, but now the demand is not strong enough to keep up with the supply. And so what you see is a declining reversal. Now, how long this lasts, we don't know. I mean, historically, it's, if you look at these numbers here in 2000 time frame here, the market went down 50%, took 2.5 years. 2008 mortgage crisis took about 1.5 years. Both went down about 50%. We've had a couple of small little bear markets here and there where, the markets, they didn't do it very long, maybe 6 months. So we don't know if this is the beginning of a longer term trend or if it's basically it's going to be a short-lived one, such as, a few months, 6 months, whatever. So time will tell. So what we don't want to do is just get back in because the market's going up for some reason. We want to wait till it hits this green threshold, which is called the bull threshold. When it hits that and goes through it, that's when we can get back in fully and reallocate more to the market. As you can see back here in year 2000, when the market right through here, this correlates with the S&P year 2000, negative here in October 2000, and it tried to make it above a couple of times, but the market wasn't ready, went on down further. But here, on March 2003 is when it went positive. So all that said, we're just watching these indicators to kind of let us determine how we're going to navigate all the ships that our investors have. Now, bonds, they went negative on February of this year. February last year. October of last year. I can't read some of the small print. October of last year, it went negative, and bonds it's gone way down, and it continued to. You saw the bond returns on that first couple of pages. We saw down 20% in some cases for the year. So as long as interest rates keep going higher, bonds will probably be in negative territory, at least on the bear side. International stocks went this year, February of this year, it turned negative, went to bearish mode. So you've seen a pullback in the global stock index. So one of the things that you want to do is control your emotions during investing. That's why we have switched over the years and stayed with fact-based investing, because people's opinions and your emotions can get in the way of investing and hurt your returns. So if you look at this report, the S&P over this period of time, 20-year period, made about 5.62%. Well, the average investor only made 3.88. And as you can see, bonds did about 4.55% over that 20-year period versus the average bond investor only making a paltry, not even 1%. So a lot of that has to do with their emotions and your irrational behavior during either overly greedish times or fearful times, such as what we're kind of entering in right now. So having a good set of research and fact-based design what you're going to do when this happens or that happens, and not based on emotions, is very important. And that's what we offer here. Real estate is still positive so far. This doesn't count the housing real estate. This is more of the industrial real estate investment trust, office complexes, and so on. As you can see here, it's still above the red and still bullish uptrends, giving back a little bit. But if interest rates keep going higher, at some point, the demand could slip off. We're already seeing a fairly significant reduction in the mortgage applications from last month over this month. And of course, resource material stocks have done extremely well due to the high demand, industrial demand for materials and chemicals and everything else. Okay, let's talk about gold. You saw that gold was down about 3 to 4% in April, but it's still up for the year. Gold has given back, and a lot of that is due to the increase of the dollar, because the dollar for now has been going higher against other currencies. Let's keep that in focus. But it's not that the dollar is in great shape. In fact, I think the opposite. The dollar is in trouble when you look at several factors, and I'll show you one here in a minute. But gold can be a way to help protect purchasing power and also currency risk, and possibly market risk as well. Through the end of April, through the end of March, our portfolios were outperforming substantially because we had about 10 to 20% or more of our clients' monies allocated into gold, silver, precious metal stocks. And when you look at our gold strength indicator, it's been positive since May of 2021. At some point, right now there's been some profit taking in gold, but still we want to keep allocated because we don't know what could happen any day when you turn on the TV and you see something major happen, a geopolitical event, a black swan event, and typically gold is outperforms during those times, especially. And you can take a look at this chart, the US dollars in the blue. When it goes down, gold typically goes up, and there's a good negative correlation to the dollar. And right now, we've seen the dollar starting to increase a little bit, and we're seeing gold kind of give back some of that upside. Long term, I think we're going to be doing fine because energy, here's energy. It went positive back in May of last year. Energy stocks and energy. So as long as energy prices stay up high, natural gas, oil, you name it, it's doing really well for the energy sector. And the dollar or oil is the largest and most strategic commodity market in the world. So every country needs oil. And if foreign countries need US dollars to buy oil, they have a compelling reason to hold dollars. So this creates a huge artificial market for US dollars. In addition, nearly all oil sales of the US dollar is used for about 80% of international transactions. So in addition to the oil sales, so huge, the dollar is used tremendously. So recently, though, some developments have been taking place. The Saudis have entered serious talks with China to sell oil in yuan, which is the Chinese currency. So Beijing buys over 25% of Saudi oil exports. So the bottom line, they're going around the dollar to buy this. So that means they're not going to have to buy dollars and artificially inflate the dollar. So why is the dollar going higher recently? Well, because of the market volatility. One, interest rates going higher strengthens needs for our treasuries, perhaps. But now Russia is also dealing with China outside of the dollar. And I believe Iran, Pakistan, and some other countries, India, are also considering the same thing. So all this is going to create some issues for the dollar, which we think bodes well for gold and commodities. So what are some of the top sectors currently? Of course, oil and gas stocks, still like them. This hasn't changed from last month, by the way. Downstream refiners, pipelines, metals, industrials and precious, commodity stocks, which includes agriculture, energy, basic materials, defense stocks. They've done fairly well compared to the market recently. Here's one of the positions we hold in the defense area. As you can see, the defense stocks have kind of been in that little uptrend here. That hasn't broken out recently out of this range. This is back in March 25th. So we're seeing this fund hanging in there compared to such things as, the S&P, which has been selling off. And of course, the NASDAQ has been selling off as well. Now, so let's keep this chart up here for just a minute. So this time frame here goes back to, let's see, that high was September of 2020. So we're getting into prices of the NASDAQ around the 2020 level. Now, there's a good possibility when you look at a monthly chart, and we could still possibly go down to this level and still not be in a total massive bear market. But this is still another what, 10 to 20% drop from current levels. Okay. Is that going to happen? It's hard to say at this point, but right now there's more probability that we'll go reach further lows from where we are today than rallying and making higher highs. That's for sure. So, and going back to that fear chart, we need that extreme fear in the market for the market to finally find a bottom. So we'll see what takes place in the coming days and weeks, but that's why we're being a little more cautious at this point. So I had one person answer the chat that said they were more bearish. Right now, they're bearish. And here's another poll, which apologize, we didn't get that set up for you to answer, but how do you think will you end up for the year for the S&P 500? It's hard to say. I mean, if I were to answer this question, I might say up slightly. I might, but who knows? I mean, it's hard to say what could happen. I think we're going to need some good news, some kind of good news to change the catalyst, to change the movement of where we're at today. So if we get some really good news and some positive things, maybe a couple of strings of good news, that might help the market up to where we end up a little bit for the year instead of being down so much. But the way things are moving in Europe and possibly in Asia and all the things, the supply chains and all this stuff, and China being shut down, it's going to really have a big impact on people, including, it sounds like, energy prices as well. So hang in there. If you need to talk through anything, let me know. I think we're doing very well where we're at today. We're well positioned, but yet if we need to get more defensive, we will. So questions, concerns, any thoughts there? Let's see. Eric said number 3. What was number 3? Let's see here. Down to flat. Okay. So yeah, that's a very good possibility. It could be down to flat. Okay. Any questions or thoughts? If you want to raise your hand, I can open it up. Since we don't have a huge audience today, we can open it up perhaps for some questions if you've got any. So there's a Q&A box if you want to Q&A, or if you want to do a chat, whatever you'd like to do. Okay, only host and panelists. Okay, so I think no questions at this time. If you want to write a question in, you're welcome to. All right. Well, if there are no questions, I'll wait just a couple more minutes to kind of, in case someone's typing a question at this point. So yeah, if anybody wants to talk, just raise your hand. But any concerns you might have or thoughts, feel free to call me. We'll look forward to next time. We do offer a portfolio review. If you're our client, we already do this regularly. But if you're not a client, you would like to have your portfolio review, please let us know, and we'd be glad to assist you with this. All right. Well, thank you for your time. Thank you for attending, and we look forward to next time, and hopefully a much improved environment. Thank you very much. Thank you.